Oh, folks, strap in tight, because today on Boss Economics World, we're diving headfirst into the hot mess that is Europe's economic landscape, a chaotic stew of bad decisions, worse outcomes, and government mismanagement so spectacular, it could star in its own Netflix special. We've got the European Central Bank, ECB, cutting rates like a desperate barber giving free haircuts, Germany throwing fiscal caution to the wind like a drunken sailor, and the looming specter of US tariffs ready to kick the Eurozone in the teeth. And guess what? It's all brought to you by the geniuses in government who think economic strategy is just a fancy term for rolling the dice. Let's break it down, from the surface-level shenanigans to the deep, dark economic disasters lurking beneath, and trust me, you're gonna want to hear this. Let's start with the headline act, the ECB's latest move. Last week, they slashed their target interest rates by 25 basis points, bringing the main refinancing rate to 3.25%, the lowest since December 2022, folks. And in true central bank fashion, they dressed it up in jargon so dull, it could put a caffeine addict to sleep. ECB President Christine Lagarde called this an evolution of policy, now meaningfully less restrictive. Translation: we're still putting out fires, but hey, at least the flames aren't licking the ceiling anymore. Meanwhile, markets are betting on the rate dropping to 2% by year-end, according to Bloomberg's World Interest Rate Probabilities. Sounds like progress, right? Wrong. This is a classic case of putting a band-aid on a gunshot wound. Sure, the Eurozone economy is weaker than a soggy croissant. GDP growth in Q3 2023 was a pathetic 0.2%, barely above recession territory, per Eurostat. And inflation? It's cooling, sure, hitting 2.3% in October 2023, just above the ECB's 2% target, according to the latest Harmonized Index of Consumer Prices, HICP. But don't pop the champagne yet. The ECB's rate cuts are a desperate attempt to juice up an economy that's been choked by years of mismanagement, not a sign of strength. And here's the kicker: while they're busy playing good cop with monetary policy, fiscal policy across Europe is about to go full bad cop, and that's where the real drama starts. Oh, Germany, the Eurozone's poster child for fiscal discipline, has decided to ditch its straight-A student persona and party like it's 1999. For decades, Germany's clung to its debt brake rule, enshrined in its constitution, limiting budget deficits to 0.35% of GDP. But now, with defense spending pressures mounting, thanks to a certain geopolitical mess, and the EU thrashing out massive new investments, Germany's about to loosen its fiscal belt like never before. We're talking 50 billion euros in new borrowing for 2024 alone, according to projections from the German Finance Ministry, and that's just the start. And the bond market? It's loving this. Yields on 10-year German bonds have spiked by 50 basis points in a week, hitting 2.8%, the highest since the Eurozone debt crisis in 2010, per Bloomberg data. Traders are practically begging Germany to borrow more, betting that a juiced-up German economy will be a safer bet to repay its debts. But here's the dirty little secret: this isn't a sign of strength, it's a sign of desperation. Germany's been so frugal for so long, its public debt to GDP ratio was a measly 63.6% in 2023, compared to the Eurozone average of 88.6%, per Eurostat, that it's essentially starved its own economy. Infrastructure is crumbling, with Deutsche Bahn's rail network delayed 30% of the time, and manufacturing PMI has been in contraction territory, below 50, for 16 straight months, according to S&P Global. But wait, there's more. The EU itself is jumping on the borrowing bandwagon, planning to issue 800 billion euros in joint bonds to fund defense spending, per the European Commission's latest proposals. Sounds noble, right? Protecting the continent and all that jazz. But here's the catch: when Germany and the EU start borrowing like there's no tomorrow, they're not just crowding out private investment, they're crowding out the weaker Eurozone countries. Italy, with a debt-to-GDP ratio of 137%, and Greece, still recovering from its debt crisis, are about to get squeezed. Spreads on their bonds over German bonds are already widening. French spreads hit 80 basis points in October 2023, the highest in a decade, per Reuters. Translation: borrowing costs for these countries are going up, just when they can least afford it. Now, let's zoom out and look at the real villain here: government mismanagement. Europe's economic woes aren't just a product of bad luck or global shocks, they're the result of decades of policy blunders. Take Germany's fiscal frugality: it's not a virtue, it's a vice. By refusing to invest during the good times, Germany's left itself vulnerable during the bad. And the ECB? It's been complicit, keeping rates too low for too long during the 2010s, fueling asset bubbles. Eurozone house prices rose 47% from 2015 to 2022, per Eurostat, while doing nothing to address structural weaknesses like labor market rigidities or low productivity growth. But the real kicker is what's coming next: tariffs. With the US election looming, there's a 60% chance, according to Goldman Sachs, that the next administration will slap tariffs of up to 20% on European imports. That's a direct hit to Eurozone growth. Exports to the US account for 3.5% of Eurozone GDP, per the European Commission. And if the EU retaliates, as it did in 2018 with tariffs on US goods like Harley-Davidson motorcycles, you can bet inflation will spike. Just look at the data. During the 2018 trade spat, Eurozone import prices rose 2.8%, directly feeding into consumer inflation, per ECB reports. So, what's the ECB to do? Keep cutting rates to prop up growth, even as inflation pressures build? Or tighten policy to cool things down, risking a deeper recession? The hawks, led by ECB board member Isabel Schnabel, are already sharpening their claws, arguing that all this fiscal stimulus will push up the neutral rate of interest, meaning fewer rate cuts are needed. But the doves, like Lagarde, are clinging to their data-dependent mantra, hoping they can muddle through without making any tough decisions. Spoiler alert, they can't. The ECB's April meeting is shaping up to be a cage match, and the losers will be the Eurozone citizens, stuck with higher borrowing costs, weaker growth, and governments too incompetent to fix it. Oh, and let's not forget our friends across the pond, because the US is serving up its own economic drama. February's US jobs report showed non-farm payrolls up by 151,000, decent, but below estimates, thanks to weather disruptions and Elon Musk's Department of Government Efficiency slashing federal jobs like a kid with a new pair of scissors. Unemployment held steady at 4.2%, per the Bureau of Labor Statistics, and the SOM rule, which signals a recession when unemployment rises 0.5% above its 12-month low, isn't flashing red yet. But dig deeper, and the cracks are showing. Long-term unemployment is up, part-time work for economic reasons is rising, and a record 8.9 million Americans are working multiple jobs just to make ends meet. And here's where the US government's mismanagement shines. The Fed's been stuck in a stagflation trap. Wage growth is solid at 4.1% year-over-year, per the Atlanta Fed's wage growth tracker, but inflation's still above target at 3.2%, per the latest CPI data. So, what does the Fed do? Nothing. Markets are pricing in a 75% chance of a rate cut by March 2024, per CME FedWatch, but Bank of America's Shruti Mishra warns that if the Fed waits too long, it could exacerbate the downturn. Sound familiar? It's the same playbook the ECB's using. Kick the can down the road and hope the problem fixes itself. Spoiler alert, it won't. Folks, here's the bottom line: Europe's economic mess, and the US's too, for that matter, isn't some inevitable act of God. It's the result of governments and central banks playing fast and loose with our money, our jobs, and our futures. Germany's fiscal U-turn is too little, too late, and it's going to hurt the Eurozone's weaker players. The ECB's rate cuts are a desperate bid to paper over cracks that government mismanagement created in the first place. And those US tariffs? They're just the cherry on top of a transatlantic economic dumpster fire. So, what can you do, dear viewer? Stay informed, stay skeptical, and don't trust the clowns in charge to fix this mess. Here at Boss Economics World, we'll keep calling out the nonsense, breaking down the data, and giving you the straight talk you won't hear from the suits in Brussels or Washington. Until next time, keep your wallets tight and your eyes wide open. This is Boss Economics World, signing off.